All right, we're going to get started with our next panel, which is Economic Outlook, What's Ahead for Brokers and Borrowers in 2026. I'd like to welcome up our moderator, Leah Zlatkin, Chief Operating Officer, Mortgage Outlet. Our panelists, Imran Thaver, Director, National Sales and Marketing, Optimum Mortgage. Nelly Yuzbazian, Director, Regional Sales and Sales Enablement, Equitable Bank. Shushanta Sen, Director, Sales, MCAP. Greg St. Clair, Chief Operating Officer, Magenta Capital Corporation. And Riza Ali, National Broker Relations Manager, Fizgard Asset Management. Come on up to the stage.
Hi, everyone. Thank you so much for joining us for our panel today. I see quite a few friendly faces in the audience, all our peeps. We're really excited for this presentation. Yeah, there we go. We're really excited for this presentation today. We've got 5 fantastic panelists here to answer all of our questions. And we tried to come up with some questions that are pretty relevant for the environment we're in right now. So without any ado, we're going to jump right in. GDP shrank by 1.6% in Q2 of 2025, and Canada lost approximately 66,000 jobs in August, which raises the question, are we in a recession? And if so, how does this affect our outlook on lending as we move into 2026? I'm going to let Sushanta kick this one off. I think he's got a couple of great answers for us, and let's hear what he has to say.
Morning, all. Well, I'm given the hot question to start off with, but I want to first just thank each and every one of you for attending, and of course, Leah for moderating, and CMP for creating this forum for us. Now to answer your question. So first, did everyone realize that we had a Bank of Canada rate cut today of 25 beeps? Yay? Okay, now, speaking of a recession, I am no economist, but I do read, like most of you do. So what's happening in Canada? We are actually already had a GDP slowdown Q2. As we all know, it takes 2 consecutive quarters of slowing of GDP that constitutes a technical recession. And of course, September will be the end of Q3. And so far, all economists predict that we are actually slowing down, and the GDP, the growth rate should be around 0%. So there are economists who are already suggesting that we are in a recession based on a per capita, based on the huge immigration surge that we had over the last 3 years. So all other pointers are towards, for example, unemployment. Unemployment right now in Canada is 7.1%, and in Ontario, it's actually 7.7%. So that is another area that shows what's happening in the economy. Housing starts, slow. Housing demand, slow. And the biggest item out there is uncertainty. I was speaking to many today earlier, and one of the quotes given to me was, "It's a wonky time." So that's me to start on this topic, Leah. But you asked the other part of the question, which is, what does this mean for lenders? What does this mean for brokers and borrowers? So from a lender's perspective, and I'm generalizing this, not just speaking for MCAP, it means definitely stricter guidelines. It definitely means focus on areas of strengths as well as weakness, be it geographically. We understand the tariffs are above our head, and we understand there's certain parts of our country that may be impacted a bit more seriously or severely than others. And of course, stress testing and other things that lenders will do. Another important item for most lenders is preserving their current assets, which is the current, the renewal book in over originating mortgages. So from a borrower perspective, from a mortgage broker perspective, what does this mean? It means that you need to keep stepping up. I saw what Joe presented in his presentation earlier. That's what we mean, is that you become the personal financial advisor. When you send your applications to your lenders, you do a great job putting in the notes, help the underwriter out, create those partnerships, and I think that's the way to go through this. Benjamin Tall says, we are going to have some short-term pain, but eventually we'll have a long-term gain.
Yeah, and I think that's a really good lead off to, hearing maybe what Optimum is actually seeing right now. Imran, will you also contribute to this one?
Yeah, thanks, Leah. And Shushanta, I completely agree with you. I mean, when we take a look at what we've seen just this morning with the 25 rate drop, we're going to, see what the Feds do this afternoon. It's kind of an interesting day for us to have an economic panel with all the things that are happening in the market. But we know that, the Feds are expected to cut as well. And I think the important thing for us to remember is kind of where inflation is at as well. And inflation right now is very sticky. What we have seen so far is primarily inflation on services. And the goods inflation is really still coming. And I think that for us is going to be important to kind of identify. And what does that lead from certainly a variable perspective, and what's going to happen longer term with fixed rates? Because, the bond market, although right now is kind of signaling the fact that, there's some spreads that we can kind of offshoot and lenders are able to kind of have some cuts towards our borrowers. The longer term approach may be that rates actually will rise on the fixed side. And I think that's going to be really important for us to kind of think about and make sure that we're thinking about what's the right approach for all of our customers. And so when you think about as a borrower and as a broker advising a borrower, you're really kind of thinking about what's their risk tolerance. And ultimately we think about how important the brokers play with the Canadian population, where we're seeing, greater than 50% of our originations coming from the broker channel. The advice that all of you in the room are giving to the Canadian public is absolutely instrumental. And it's so critical for us moving forward that you guys have good understanding of what's going to be coming in the marketplaces ahead.
Yeah, I think that's a really great lead off. And Sushanta, I know that you kind of alluded to this. We are seeing some unemployment, and we know unemployed borrowers are historically the main cause of borrower default. Given 100,000 Canadians lost their job in the past 2 months, have you seen defaults increasing and borrowers asking for payment deferrals? The other side of that has the number of borrowers making prepayments changed over the past 12 months. What are you seeing in terms of borrower behavior right now, and what should brokers be paying attention to when it comes to defaults and risk for our clients? I'd love to sort of pass this one off first to Riza, maybe.
I thought you were going to say Greg. Thanks, Leah. And again, I'll echo, thank you all very much for joining us here today. We talk about borrowers and how they're looking at, we're looking at borrowers today. We've seen a real shift in the quality of borrower. I'd mentioned to the group earlier that in the first quarter of this year, I started seeing this trend, and I mentioned to our team that I've seen more 500, sub 500 credit scores than I've seen in the last 7 years. And that was a real indication of kind of what we're into today. Fast forward. And, when we really look at our business and how we're going to position ourselves to make sure that, we're here for all of you and your clients, that is a key factor that we have to look at. It's not just about the property and location and loan to value. Looking at the borrower and their capacity to be able to repay and manage the debt loads so that they're going to find themselves in is extremely important. So, my advice for you guys, these are tougher conversations to have for sure. And I always say if you don't have a degree in psychology, you might want to start reading up on it a little bit, because again, you have to handhold a lot of your consumers through these challenging times at this point. I'll pass it over to Greg if he wants to throw in a comment.
Yeah, thanks, Riza, and thanks, Leah, and everybody for attending. I mean, FizGuard and Magenta are both mixed. We're seeing a very similar trend, right? Lower beacon scores, higher debt loads, stuff like that. And it is really about how do we best find a solution for your clients that fits for us and for them. And sometimes we have to say no. And I think that's what Riza's alluding to is there's going to be some tough conversations in the future. It will get better in the long run, But there's some challenging points ahead of us. It's going to be very regional. Building off of what Sudhantha said, it's RBC described it as regional recessions is a very likely outcome due to the tariff impacts. So where your borrowers are located, what job they have, what sector they're in, is all going to tie into the overall conversations across the board.
Yeah, I agree with that. And, I think you guys have a fairly good cross section here. We lend from Ontario to BC. Imran, you're located out in Alberta as well. It is regional. We hear a lot about how depressed Ontario may be, how depressed BC is. When you look at regions that have seen that quick run up, and even within Ontario, but now considering Alberta and our lending practices out there, the lenders really do have to start paying attention to the shift in those markets. We're seeing pockets. So you'd mentioned something about delinquencies, right? And borrower profiles. I think that a lot of that comes down to the lending practices of any lender out there and their risk management. So have they adapted quickly enough to be able to manage what has come down the pipeline? And staying on top of things is no different than you guys staying on top of the shifts in the market for your consumers. We have to look at those impacts to, again, Greg and I are mix to our investors and our investor base. What does that do for them? So those are some of the factors. When it comes to delinquency, has it risen? I'm sure it has everywhere across the board for lenders in general, but those that do a better job at managing the origination side, they're going to see less of that on the back end.
Well, I think it's actually really interesting because when we look at originations, I do personally find that with my client base, I've seen a bit of a change in the last 12 to 18 months for the types of applications that are coming in. I know this is a bit more off the cuff, but have you guys actually seen changes in the profiles or particular demographics that are changing in the last 12 to 18 months, maybe specific to first-time home buyers or like certain types of people whose applications are deteriorating a little bit, or like, are you seeing any trends as a lender in this space? Go ahead.
Thank you, Leah. Definitely the trend is towards what we see is an overextension of current debts. Interestingly, when you talk about demographics, it's just not the Gen Y, the millennials, or even the Gen X who are entering the market. It's also the baby boomers who are trying their best to keep up with cash flow, trying to help out their children or grandchildren, or even creating their own retirement lifestyle. So that's a concern for lenders, especially in our space. And at MCAP, being the largest mortgage finance company, it's important that we are aware and be available for workouts with different customers. But to talk about the origination of files, we do see a lot of files that we cannot support due to some of the risks that I just mentioned.
Yeah, maybe I'll add to the fact, because you talked about kind of risk management. And I think that's one of the things that we're doing really well. And I think all lenders, when I say we, I mean all lenders are really kind of working through their books right now and saying, from a special loans perspective, what can we do to support our borrowers? What can we do? Have the conversations, share with your borrowers that if there is going to be some challenges ahead, to have the conversations with us as lenders as soon as possible. Right? Because there are many tools that we have that are available to us where we can support, we can do some extensions, we can look at creative ways to making sure that before we go into impairment, before we even go into delinquency, that there could be some support that as lenders, we can do to support the borrowers.
Yeah, 100%. I think that's a great point there. Personally, I'm also seeing a lot more applications from lower credit and overextended borrowers, just like you're saying there. At the same time, we're entering what is historically a very active period for transactions. Managing capital on hand to meet that demand is critical from both a lending and an investor perspective. How are lenders balancing support for borrowers, capital management, and credit risk at this time? I'm interested in hearing from Nellie on this one, as I know you guys do a really good job on this.
Sure, yeah, thank you, Leah, for having us here. So I think we all agree that mortgages have become very complicated, right? So there's been a lot of regulatory changes over the past several years. So for us as a lender, obviously our risk appetite has tightened, right? So, we're always assessing the market. We're always looking for the different ways to kind of be careful around how we lend, especially given, people are overextended, right? We want to make sure that these people can actually make their payments. So, we also, as the seventh largest bank, a Schedule I bank, we raise capital through broker GICs, covered bonds, and our EQ Bank platform, and we also now have a small business banking. So that's how we have funding come through, where then we deploy that into our mortgage, right, as our capital management. So it's important for us to be able to know that our customers or our broker partners and their clients are able to make those payments. So we have to be tighter on our risk appetite given the current conditions right now.
Amazing. Thank you, Nelly. Imran, do you have anything that you could add to that?
I think one of the things that's important for us is also to consider lending areas. And collectively, the panelists, we were talking about this earlier. One of the things that's important when we think about the challenges that could come into place is how quickly can there be liquidation of properties? What can happen if things do go awry? And so we talk about restrictions from perhaps being tighter from a credit perspective. I think we're also collectively looking at what are some of those areas perhaps that are more pressured. And I don't mean to say we're not going to go into rural markets, but perhaps we need to think about where those areas are. Are there, a little bit stretched beyond what we typically would do? Can we look at areas that, are going to be not necessarily urban areas, but grow in different pockets? So I think it's going to be really interesting as we all have unique appetites and different appetites across the table here. But we're certainly looking at different areas and certainly different types of properties. And so if you ask us today how we view condos versus what we would have, 18 months ago, 2 years ago, all of us would say we're probably a little bit tighter on condos.
I think we're all in the same boat with that. We're all in the same boat.
I think we're all in the same boat, right? And so we're not just looking at areas, we're not looking at just credit, we're also looking at the type of property we're looking at as well. And so there's going to be a whole host of factors that, economic pressures will make sure that we're looking at a little bit more differently.
Yeah, I'm just going to pivot on that for a second, and I would love to hear from Riza on this. I'm interested in understanding, we're talking a lot about originations. As files are coming in, how are we viewing that risk? I'm also curious about how you guys are managing risk for existing clients. So clients that are already in your profile, how are you working on managing risk internally?
I wanted to just touch on the capital management piece as well, because these three guys here have a lot of money coming in, and then we've got Greg and myself as a MIG. There are different business models here on stage, and just to help you guys understand, as MIC operators, we don't necessarily have that same flow of capital coming in to the same level. So managing that capital is critical for us as an operation, and just looking at, when you're talking originations, it's really a fine balancing act. So looking at the demand and choosing the quality of that business coming in to hopefully then exit them in a timely manner so that we still have that flow of capital, whether it's on the origination of the capital or just that money coming back to us in a timely manner. That's where it's very different between all our models here. Now, the second question was internally. As us as an operator, our view on things is we're not quick to pull the trigger. So we do like to work with our consumers. Someone set it up here. Listen, guys, if your client's coming to you and they're struggling, the first thing I always say is let us know as quickly as possible, because then our folks on the inside can get on it and try to figure out what's the best course of action for that client. And we do want to work with them. We're not in the business of taking property, kicking clients out of their houses or anything like that. That's not what we're in business for. So to your point, we'll try to figure out the best solution for not just the client, but us as a business and our investors as well. So whether that takes a month, 5 months down the road, it may come to a realization where, you know what, they have to sell.
Yeah, and I think that's actually a really good add-on for all the brokers in the audience here today. One of the critical components of being a mortgage broker is obviously keeping in touch with your clients. So following up with people on a regular basis to understand if they're going through challenges or struggles is a great way to not only re-leverage your existing book, but it's also a really great way to recognize if somebody's having a challenge that you need to contact the lender about to help understand if they're going to need deferred payments or another kind of option. I do think that, Sushanta?
If you may allow me, just on behalf of the MCAP group of companies, MCAP, Merix, RMG, we also have Lendwise, as well as our Eclipse and NPX brands. We do try to offer the best options that we are able to. We're speaking about prudent capital management, so I thought I'd share that and then we have a great audience here and great panel who also offer alternate services. And it's very important for mortgage brokers, many of you here in this room, that you make the right fits. When you send in the deal, that you really give us the know your client information so that we can not only enable you in the experience that you give to your customers, but in turn, also accept the right fits for our capital, because we want to really manage that prudently.
Yeah, that's a great point. Nelly,
If I can just add, also from a lender perspective, to your point, it's really understanding what products we have available that will work for the client, right? Like being able to position them in the right product also makes sense. And it might not be something that they need today. It might be something that they need in the future, right? So partnering with your lenders, understanding the products before you can share the information with your borrower, I think that's key.
If I may, I mean, it's such an important question. I think it's a great question. Riza hit it on the head. There's a lot more options for these three to go out and raise capital than there are for Magenta and Fizgard. And the networks to raise capital and to source mortgages are very similar. They're very time intensive. There's a lot of work that goes into it, and sometimes lots comes in and sometimes very little comes in. So it's about managing all of that. And how we focus on it, and I think Fizgard does the same, is sticking to our bread and butter. Right? What types of loans are we doing so that we're delivering on our promise to our investors and they're getting the fund that they expect to get and the return that they expect to get. And that ties back to tightening our lending criteria at times in rougher times. And then we can be a little more open when times are better. And that's kind of the cycle that we go through. But nobody wants default and nobody wants loan loss, because investors very easily understand that and expect that. And that's why it's so important when we're talking about renewals and stuff like that, or working with clients, that we want communication. We want to know in advance, and we very much want to work with clients. We believe in collaborative default, where our default team is working with them to find solutions. We might be able to defer a payment or two. Sometimes you just can't avoid it and you've got to go, power a sale, but that's our absolute last resort, and we'd prefer any other solution to that.
Yeah, that's a really good sort of pass into our next topic here, which is, as a lender, it's really tough to sort of manage staying in the sweet spot between managing risk and also reward with the current headwinds that we're in right now. Looking beyond rates, what kind of demographic or policy changes are we expecting will shape the mortgage demand in 2026? What are you guys seeing in terms of policy shifts or changes? Maybe I'll start it off with Imran.
Well, I think when we took a look at some of the headwinds we're seeing, I mean, you take a look at the changes that's happened from an immigration and student cap perspective, the foreign buyers ban that got extended, capital gains inclusion rates, there's a lot of things that are happening that are impacting us collectively as lenders. So we need to think about those things from a broker perspective, and how lenders are going to respond to that is going to be different based on each of our own criterias. And so these are all things that we're looking at. And so when we take a look at the lower certainly immigration coming in, what is that going to do for the oversupply challenge that we're seeing in Ontario and British Columbia? We're now starting to see some of those cracks in Calgary, and so it's not just based in some of the typical areas where we saw the overbuilding of condos in particular, but we're starting to see it stretch across different parts of the country as well. And so we're really looking at how we have to adapt our policies with respect to that. And I think that's an important thing for all of us to take note of.
Yeah, that's really important. Greg, do you want to contribute to this one as well?
Sure. The immigration's the big one, right? And we're seeing so many more rental units coming online, and the immigration, the population isn't going to be there as well. So I think that's a huge piece of all of this. We're really focused on regions and the regionality of it. What's going to be impacted by tariffs, what's not. So aluminum, steel, manufacturing is obviously the big impact. That's the vast majority of job losses over the last little bit, is sector specific to those, which is a positive for the other sectors at this time, but a significant negative for those sectors. So regionality within that's very important. The elephant in the room, and we're finally there, is CUSMA. What's going to happen with that? Right? 90% of our trade, or 85, something like that, is covered by CUSMA. It's effectively tariff-free. If that goes away, everything we say here is done, really, because nobody really knows how bad it could get. But that's a key thing that we've got to keep an eye on as that process starts over the next 6 to 12 months, and go from there. So that's the probably biggest policy thing that we're keeping an eye on. And then where's the federal and provincial governments investing in for projects, and how might that impact employment?
Yeah, so there's a lot of policy changes that could be outside of our direct lenders, government, et cetera. Sushanta, do you want to speak?
Yeah, I just want to add to the points Imran and Greg just shared, maybe share some numbers. I just love numbers. So immigration, and you mentioned about CUSMA. Now, the immigration, we're talking about the moderation of the new workers to Canada. The reduction is going to be to 5% that's the plan, from 7%. But in terms of CUSMA, I think what I find very fascinating, or maybe not fascinating, not the right word, interesting, is that the CUSMA, where, as you articulated, 90% of items are covered other than steel, aluminum, and cars built, is that this can be called off within 6 months. The next CUSMA review is coming up July 1st, 2026. So as much as we are excited about 90%, that the real tariff increase will be like 5.6%, I think it's a caution out there that this uncertainty can prevail even longer.
Yeah, I think that's a great point. Nelly, do you want to contribute to that one too?
Yeah, so I think going back to the demographics, I think one piece we're also missing is the aging demographic that we have in Canada, right? So I think that one's really key, because in the next 10 years, we have 3 million Canadians that are actually going to be retiring, right? So just want to throw some stats out there. I know you love the numbers, Leigh.
I do. I love the numbers.
So out of those 3 million, the survey has been done that they expect to have 1 million in savings when they retire. Right now, the average Canadian that's 65 plus has $275,000 in savings. So that's a $725,000 gap, right? So reverse mortgages is probably, I'm not trying to pitch a product here, but reverse mortgages is probably where, if I do pitch it, you can go to our booth. But reverse mortgages is probably where we're going to see we're already seeing the double-digit growth there, but we're going to see a huge uptick there. So I think that's one thing that brokers need to be aware of in terms of our demographic and how many people are actually retiring in the next 10 years or so. There's going to be a huge shift.
Just to sort of dovetail on that, why is that relevant for the people in the audience today? Okay, reach out to your clients and talk to them about their parents. Reach out to your contacts and talk to them about the older people in their families that are looking to retire. That's a great referral source. Hey, I've got a new product that I can talk to you about, or I've got a new topic that I'd like to discuss with you. We're finding a lot of people that are getting closer to retirement. Hey, here's a great way to mine your audience base, your client base. If you're feeling like your book is a little slow right now, all of these mining strategies, mining for demographics and things like that, those are really going to help you boost your book right now when we're seeing the markets a little bit slower for this time of year, when normally people see a bigger boost.
Yeah, and it's not just about retirement too, right? What we're seeing as well is there's a lot of wealth transfer, right? Like people are already thinking about it ahead of time, where they want to give their early inheritance, right? And these are ways that people are thinking about it now. So to Leia's point, make sure you understand your clients' needs about their parents, grandparents, etc.
Yeah, Imran, you want to?
Yeah, just going to add a little bit. And this was talked about in one of the panels earlier this morning. But when you also think about, the shift in policy and us as lenders having to kind of think about things, you take a look at generational homes. And we're starting to see this shift of, in the past, it could have been, you turn 18, you move out. And when we take a look at the demographics and the changing of how affordability is impacting individuals' qualifications for homes, we're seeing, 30-somes now staying at home. And now we're also starting to see the opposite where, I'm having to take a look and saying, what can I do from a housing perspective to take care of my parents? And so we're seeing a lot more of the generational homes. We're going to have to make sure that we're coming up with policies to address those. And we're also going to have to look at differentiated income and income streams. And so no longer can we just say, hey, look, we're going to accept, income stream A, B, C, and D. But now we're going to have to take a look and say, well, how do we anticipate from a generational perspective how we have to look at multiple streams, multiple different ways, because the landscape is shifting dramatically and it's going to continue to shift. And so as lenders, we're going to have to continue to adapt to that.
Yeah, that's your lender policies coming into play and looking further down the street. Now, I just heard a rumor that you guys are going to get into reverse mortgages now after Nelly mentioned it.
I don't know. Reverse mortgages are a hot topic right now. I mean,
But,
it's I think all lenders are starting to consider that.
I wanted to mention something also, and Imran brings up some really good points. But in my conversation with brokers, you guys really do need to look at your demographics of your clientele, your book of business in general. There are people out there that have money and they are ready to purchase. The market we're in right now is a great market if they have the resources to do so. And there are, believe it or not just in Toronto, there are a lot of people with money out there. So search them out, and start building your book with those clientele. When I hear jobs reports and unemployment stats, I always look at what's it really made up of? And are we losing full-time positions? Because that's a huge impact right there. Or are they when they're creating jobs, is it full-time jobs or is it just simply part-time jobs when we were growing up would be looked at as stepping stones, for high school and college kids that now we're finding 60 and 70-year-olds in because they have to. So start really looking at all of those items because that's going into the future. It's already here, but I don't see that slowing down necessarily with the environment that we're in.
Yeah, I think that's actually a really great point for everybody in the audience as well. A lot of us are, worried about the economics that exist in Canada right now. We started off this conversation talking about a recession, but I think Riza brings up a really awesome point, which is, for me personally, I've had a lot of first-time home buyers who have been sitting pre-qualified on my books for years and years and years, and all of a sudden now, over the summer, they're all buying houses. Okay, well, why is that? Because housing prices have gone down so dramatically that they can finally afford the townhome, the middle row townhome that they couldn't afford for the last 2 or 3 years. They can finally get into the market. So this is a great opportunity to, again, mine your books, look at who you've got pre-approved, who may have had a lower budget before, but who can all of a sudden get into that home. So I think those are really great points and, great for all of us in the audience who are thinking about how do I bring more business into my book. In such an unpredictable climate, what advice would you give brokers to remain resilient and continue to support their clients effectively? And that's sort of to dovetail on this. Go right ahead, Susan.
I stole this line from one of my colleagues at MCAP. Uncertainty is the only certainty. What do I mean? So brokers who win are ones who double down on education, who are focused on their customers, not as their mortgage advisor, but as a financial advisor if possible. Someone's looking beyond rates. Someone's looking at their client's real situation, like know your customer, who's passing that on to the lenders or other stakeholders in the industry, who are seeking help and consulting with their BDMs, their underwriters, their BRMs, fellow other brokers, leaders. And at the end of the day, it's all about the experience and making our industry very sound and strong.
Yeah, I think that's a great answer. Nelly, do you want to contribute to that?
Yeah, so as a lender, actually I have one for you. Change is constant, right? So I think that's one thing we all agree with. But So as a lender, I think one thing brokers have to, during tough times, really understand is the story of their client, right? Not just submitting the file, right? When you're packaging the file or trying to submit that deal, the lenders really want to know the full story, right? Not just seeing their income, credit profile, etc. The whole package, really. How do they do business? Why do they do that type of business? If they're self-employed, where are their expenses? Like, what are you seeing? And then if there is any debt issues, right? The whole story, even and what's their exit strategy? So if we can understand that one advice that we would give to brokers, especially during tough times, is just make sure you know the full story, because when you want to get that deal approved, we need to know the story to be able to get it done faster. So that way you also build the trust with your client, as well you build the trust with the lender, right? So it's a double win.
And I think that's also a really good reminder. We've had a lot of policy changes taking effect over the last little bit. FISRA has come out with new policies and things like that. It's more critical than ever before to understand and know your clients, and also to understand and know where their money is coming from, not only from a compliance perspective, but just for a sense of good brokering. So just a reminder, definitely KYC is critical more than ever right now. Go ahead, Greg. I think you wanted to contribute as well.
Yeah, and Nelly hit the nail on the head, and I describe it as come with a plan. Especially for mix like us, we're 1, maybe 2 year lender is our ideal. We want to be that stepping stone. Come with a plan ready for the underwriters, because you will get asked, what's the exit strategy? What's the plan for this client? Come with something that's very organized and ready to communicate. That will help us have confidence in funding a deal. If somebody's in a sector that's more likely to be hit by tariffs, okay, what's the plan if they get laid off, right? How are we going to manage that? And I think lifetime value of a client is critical at this time as well. So as Leah said off the top, stay in touch with your clients more, help them build plans in the interim. You mentioned having multiple people who were waiting to get into the market. It was 3-4 years, but now they're getting in. It's thinking more lifetime value in this type of cycle is how I'd be approaching it.
Yeah, absolutely. Imran, do you have any thoughts on this?
Yeah. So, Greg, you talked about understanding your customers and KYC, know your customers, know your lenders. We have a room full of, an incredible amount of lenders and BDMs. And so I say this in all honesty, abuse your BDMs, right? Not physically, but,
Not mentally either.
Please don't abuse your BDMs.
not just the optimum ones, but, but certainly call your BDMs, understand what can work, what will not work for your individual lenders, run deals past your BDMs. They know the products inside and out. They know what the appetite is going to be. And, appetite could change based on what's happening in the environment. And so we could be sitting here today talking about what we're experiencing right now. And next week, the market could be dramatically different. And I think it's so important that we're all shifting in terms of what's going on in the marketplace today. We have some private lenders here in Mix that their nature of their business is shifting, honestly, all the time. And so we really need to make sure that we're understanding what's going on in the marketplace today. And so use your BDMs, use the people that you have access to really understand whether that deal is going to fit with that particular lender or not.
Yeah, I think that's a really great point. I'm going to pass it over to Riza.
Yeah, I just wanted to, so we've talked a lot about knowing your clients and lenders as well. I look at people coming into the business or those that have been in the business for a while now, and I always like to ask, do you guys have a plan? What's your plan? Have you put a business plan together? What does it look like? Is it just simply transactional and you're focused on, I just want to do a mortgage? Or do you want to do more for your consumer? When you look at your customer, do you just want to do the mortgage for them, or do you actually want to see them flourish in their financial life as well? Maybe dealing with, as you mentioned, generations of families, depending on how long you've been in the business. But I think that's an important piece, especially in times that we're in right now, is solidifying your business, making it a long-term venture. What is your plan? And do you even have one?
Yeah, and I think that's a really critical component. Most successful brokers I know, they don't view their clients as purely clients. They view their clients as somebody who they're helping for a lifetime, not only helping that client, but also helping everybody else in their network. And if you view your clients that same way, you're going to generate a lot more business for yourself. I'd love to pass it over to Sushanta.
I just want to build on Reza's point, and we have three of our lovely BDMs right here: Lucy, Sylvan, Corey, and abuse. I know, and you meant use your BDMs. I would definitely also encourage each and every one of you to do that. There's a mantra or formula that we use at MCAP that's going very well for us: is activities times efforts will equal results. So focus on your activities, make it real, thoughtful efforts, and results will come. And one thing that I would just add to that: don't give up easily. Just stay on it. Be resilient. Success will follow you.
Okay, I'm going to let Imran close this one off, and then we're going to pivot over to another question.
Okay. So I just want to also mention, set realistic expectations with your borrowers. The environment we're in today is not the same environment that we were in, 18 months ago, 2 years ago. Timelines take longer for us to review income documentation, especially given some of the types of lenders that we have on this panel here. The rush deals sometimes will raise flags, and so that's going to be important for us to really uncover why things are a rush, what's going on. Just set appropriate expectations with clients. It's really critical as we move forward, especially in more stressful times and times when the economy may be shifting.
Thank you. I think that's a great response. Okay, this is a bit of a hot seat question, just because we're talking about changes. This is our last question because we are running out of time, but I'm curious to know what you guys think. So we'll kind of go down the line and we'll see what people have to say about this. We wanted to talk a little bit about which products are most in demand right now when it comes to, fixed, variable, alternative. We obviously saw the rate drop today. I'm curious as to what you guys think clients are going to be interested in pivoting towards or staying with, given these unprecedented times. So maybe I'll start over on Greg's side and work my way this way, and it'll be our sort of close-off question here.
Well, thank you for that. It's a great question. From our perspective, we don't do variable products. We only do fixed. So that's really the only option that we offer in the market. But broadly, I would think in times of uncertainty, which we are in, although it is trending better, people are probably going to default to fixed, right? Because they want that certainty and price point. Even with the potential of further rate cuts, my gut is that's probably where people will want to land. But that's also why you all are here to be the experts to give that advice too, right? And provide that opinion that's best for them. But that would be my gut thought on it.
Awesome. Thank you, Greg. Go ahead.
Yeah, that's the question I think you will answer for your customers based on their own strategies. Like variable rate is coming back into fashion. We know why today. It's probably going to get even better before the end of 2025. But is that the way for everyone to go? Only you will figure it out with your customers. Now, Imran mentioned, although the BOC rates may come down, whatever, another 25 or 50, that doesn't mean that the fixed rate 5-year rate will follow suit. There may be a diversion of the two. So keep that in mind. And we also know 2 years back what happened to variable rate holders of mortgages. So this is a huge question, and this is where you go deep into conversation and share the risks and rewards of each one of those two terms.
Thank you. Nellie?
So I agree. Since we have 2 minutes left, I think it's a very long-winded question, but that we can all talk about. But
Hot seat.
definitely, I think we have seen short-term be on the hot seat. So luckily, we're the only alt lender out there that provides a variable rate. So our ARM product actually this year had gone up. So this year, it was 20% of our funded volumes. Last year, it was 15%. So we're seeing an uptick on the short term for sure. And I think given that customers are wanting to wait and see what happens even more with the BOC, with the Fed, I think they're still going towards the short term just to be able to have a plan when rates drop, and then they can maybe go long term. But we're definitely seeing short term.
Awesome. Thank you. Imran?
Nelly forgot that Optimum also provides variable rate mortgages as an alt lender. So I'll
Is that a new thing?
I just matched one of your rates. Come on. Again, great question. I think it's really going to be situational based. What's going to be the right rate and the term for the borrower and the client is going to be really based on the broker understanding and, really doing their due diligence to make sure that they're uncovering the right needs of that particular situation. If we look broader, I think fixed rates are going to be a little bit more expensive than variable. I think but the difference isn't going to be massive. I think you'll save a little bit on variable over the shorter term, and it will end up being a little bit cheaper on variable.
Awesome. Thank you, Imran. Lastly,
Okay. I've got to talk really fast now, right? Okay. So my view on this is it is entirely on the client situation. It's not, I don't think it's necessarily up to us to say you should only do one or the other. You have to, I talked about plan. That goes in hand with the plan that you discuss with your consumer and how variable or fixed falls into that. So variable though, in my opinion, what I always look at is where's the discount? And that's the real advantage to variable as it fluctuates up or down. And is that a deep discount that's going to benefit the consumer in the long term and falls within the plan that they have for themselves? Whether they're younger or older, and you see typically the younger first-time buyers will go fixed so that they can adjust their budget and have some certainty. That's my view on it. I don't think it's up to any one of us to dictate. It has to be tailored to your particular consumer.
I think that's a really good answer. And just to sort of highlight what Riza is saying here and to close it off for the last 10 seconds, it really is very important to know your clients. Not every client is a fixed client. Not every client is a short-term client. Not every client is a variable client. It's really important to KYC, know your client, and pick the right solution for that client so that they'll come back to you again when their term renews. Thank you to all of our panelists for this one.